Somewhere inside Adobe's own internal reporting, every customer on Earth gets sorted into exactly one of two buckets. Bucket 1 holds Hollywood colorists, Fortune 500 marketing departments, and ad agencies billing millions of dollars a year. Bucket 2 holds a college student cropping a photo for Instagram and a small law firm getting a client to sign a contract. Ostensibly, both of them might open an app that looks identical, click the same button, and see the same interface. But Adobe doesn't see two similar customers doing similar things. It sees two entirely different businesses worth two entirely different amounts of money, requiring two entirely different strategies to keep them paying every single month. That split is not some minor internal detail, it is the actual architecture behind how a photo editing tool turned into a company worth $25 billion a year in revenue, up from just over $7 billion less than a decade ago. It is also the reason Adobe has survived challenges that would have sunk almost anyone else. From rampant piracy in the 2000s to a wave of generative AI that was supposed to make creative software irrelevant. This is how Adobe actually makes money. For most of Adobe's recent history, the company reported its business in two broad product lines. Digital media bundled together every dollar earned from Creative Cloud and Document Cloud, and digital experience captured everything tied to Adobe's experience platform. That structure was organized around what Adobe sold, not around who was actually buying it, and eventually it stopped making sense. A film studio color grading a national ad campaign and a teenager touching up vacation photos were being sold the exact same product, priced and marketed as though their needs, their budgets, and their reasons for opening the software were identical. They weren't. So Adobe rebuilt its entire internal structure around a simpler question. Not what software are you buying, but who are you? On one side sits what Adobe now calls creative and marketing professionals, the studios, agencies, and enterprise teams that treat the software as critical infrastructure. On the other side sits business professionals and consumers, everyone from a corporate legal department to a freelancer making social posts on a weekend. Together, these two groups generate that $25 billion. To actually understand where the money comes from and where the real risk to that money is hiding, we need to walk through both sides of that split, then look at the technology Adobe is betting its future on, and the competitors trying to take pieces of all of it away. Let's start with the professionals, because this is not a hobbyist market and never was. Picture a colorist finishing a feature film before a festival deadline. A creative director at a global ad agency building a campaign that will run in 40 different countries. A marketing analyst inside a Fortune 500 company stitching together data from a dozen channels at once. An elite freelancer good enough that agencies plug her directly into their own production pipeline as if she were an employee. What unites all of them is not talent, it is dependency, backed by genuinely enormous software budgets that most consumers would find absurd. None of these people can quietly switch to a cheaper tool on a whim, because their work never exists in isolation. A single video file has to move through a colorist, a sound engineer, a motion graphic artist, and if any one of them opens a different program, the whole chain can break. This is the world Adobe built Creative Cloud for. Photoshop for raster images, Illustrator for vector art and branding, Premiere Pro for video editing, After Effects for motion graphics, InDesign for page layout, Lightroom for managing tens of thousands of photos at once, and more than 20 other applications bundled into a single subscription. An individual can rent the whole suite for roughly $60 a month on an annual plan, or close to $90 with no commitment at all. Over less than a decade, revenue tied to this bundle grew from a little over $4 billion to nearly $13 billion, compounding at roughly 17% a year, and that number is only the beginning of why professionals stay. Here's the mechanism most outside investors underestimate. When someone saves a file in Photoshop, Illustrator, or InDesign, they are not creating a simple picture. They are creating a dense container holding layers, editable text, embedded color profiles, and edits that can still be undone months later. Adobe doesn't publish the technical blueprint for how these files are actually built. So when a rival app tries to open one, it is essentially guessing and guessing badly. Fonts drift out of place, gradients fracture, carefully calibrated colors shift into something slightly wrong. In an industry where a shade of red being off by a fraction of a percent can cost a global campaign real money, that rendering risk is not a small inconvenience. It is a reason to never leave in the first place. Especially since professionals rarely trade a finished picture at all. They trade a raw, editable source file, which means the format itself is not a technical footnote. It is the language the entire industry is forced to speak. Now multiply that across an entire supply chain. An ad agency does not work alone. It coordinates with outside colorists, illustrators, and typographers, and every one of them has to open the agency's files without breaking anything. So, the agency simply mandates the same software across everyone it works with. And a freelancer who refuses to keep paying for a subscription quietly gets cut out of the referral network entirely. Zoom out further and you find printing presses, packaging manufacturers, and post-production studios that have spent decades calibrating physical machinery specifically around these file formats. Ripping that out is not like switching a phone plan. It is closer to rebuilding a factory floor, and when the cost of leaving a piece of software gets measured in factory downtime instead of a monthly bill, you are no longer looking at a software company, you are looking at infrastructure. This is also the reason why Adobe can raise prices most years without losing customers over it. A 5 to 10% increase costs a studio a few extra dollars per seat. Refusing to pay it and retraining an entire pipeline on unfamiliar software costs that same studio millions. Given a choice between a minor annoyance and a genuine catastrophe, almost every enterprise customer picks the annoyance. Add it all up, and this part of the professional segment, the studios, agencies, and enterprise marketing teams, now accounts for 50% of everything Adobe earns, and 71% of creative marketing professionals, with the core professional slice of Creative Cloud alone estimated at somewhere around $12 to $12.5 billion a year. But enterprise clients need more than a finished creative file. They need to know that the right version of that asset reaches the right person at the right moment. Across every channel a company touches, a website, a mobile app, a physical store register, an email inbox, that is what Adobe Experience Platform exists to do. And it behaves almost like a nervous system stretched across an entire corporation. The first part is called Customer Journey Analytics. It acts like the census, stitching together everything a customer has ever done, browsing anonymously on a laptop, then finally logging in on a phone weeks later into the continuous timeline instead of a dozen disconnected fragments. And it does this by reading data directly out of a company's own cloud warehouse rather than copying it over first, which alone saves enterprises a fortune in infrastructure costs. The second part, the real-time customer data platform, acts like the brain. It doesn't personally send an email or design a banner, it simply decides in a real time what should happen next, then tells other tools to actually carry it out. Feeding that brain is Adobe's digital asset management system, which behaves like a bottomless closet holding exactly one master version of every photo and video a brand owns, then instantly resizing and recropping that single file into whatever a Japanese mobile screen or French billboard happens to need. An older Adobe AI called Sensei automatically tagging every asset the moment it gets uploaded so nothing ever gets lost. And the final piece, the content management system, is the face customers actually see. The website and app rebuilt in every language, the instant headquarters updates one master template, whether that customer is looking at a browser, a phone, or a screen inside a physical store. Watch how those four pieces actually work together in a single moment. A shopper browses a pair of shoes anonymously on a phone, abandons the cart, then opens a marketing email 3 days later on a laptop. Customer Journey Analytics recognizes that laptop and that phone as the same person instead of two strangers, stitching the sessions into one timeline. The real-time customer data platform reads that stitched profile and decides instantly that this specific person should see those specific shoes again, this time with a small discount attached. Digital asset management doesn't have a pre-built banner sitting around for that exact combination of shoes. discount, and screen size, so it generates one on the spot from the single master image it already holds on file. And the content management system drops all of it, the layout, the price, the picture, straight into the email or web page the shopper opens next. No marketer manually built that campaign, and nobody wrote a line of code connecting any of those four systems to each other. Adobe sells the promise that this entire loop, from an abandoned cart to a personalized follow-up, runs on its own in well under 15 seconds. No API needed. And because these enterprise clients pay based on the sheer scale of data flowing through the system rather than how many employees log in, locked into contracts running 3 to 5 years and built up front, Adobe's fees quietly climb every time a client's own business grows with no new sales required at all. That alone accounts for close to a quarter of everything the company earns. Enterprise creative work, as massive as it is still only 71% of the picture. The other side, which is 30% of Adobe's business, barely resembles the first. This side concludes corporate knowledge workers doing legal, HR, finance, and procurement paperwork, small and medium businesses, solo freelancers who are not creative professionals, students and educators from kindergarten through graduate school, and ordinary consumers editing a photo purely for fun. None of them are locked into a decade-long industrial pipeline. Most of them could leave tomorrow if something better came along. And yet, Adobe still expects around $7.5 billion this year from this group alone. Built substantially on one document format most people never think about twice. This is important. Before 2008, creating a PDF required Adobe's own paid software. Full stop. And that restriction actually threatened to blow up in Adobe's face. When Microsoft tried building a free save as PDF button directly into Office, Adobe threatened an antitrust lawsuit large enough that Microsoft backed down and pulled the feature. Adobe had won that fight and was quietly losing the war. Because a format this expensive to create could never become the true global standard it needed to be. So in July of 2008, Adobe made a decision that looked on paper like giving away the family business. It handled the complete PDF specification to the International Standards Organization for free, forever. Within what felt like months, Microsoft built native PDF creation into Office, Apple built it into every Mac, Google built a viewer straight to Chrome. The floodgates opened, and PDF stopped being Adobe's product. It became the legally recognized paperwork of the entire modern world. That wasn't generosity though. It was one of the sharpest strategic plays in software history, sometimes called commoditizing your complement. Make the basic version of something free and massive, and you expand the entire market for the premium version sitting right behind it. Billions of free PDFs now move through the world every year. And the instant any one of them needs editing, security, legal binding signature, or compliance tracking for a regulated industry, the free tools stop being enough. Acrobat Reader, the free viewer sitting at the center of all of this, came actually pre-installed on most new computers for years, training an entire planet to associate the word PDF with the Adobe name long before anyone had a reason to pay for anything. That flood lands directly inside Adobe's pay tiers. Acrobat Standard and Acrobat Pro, alongside Adobe Sign for digital signatures, Adobe Scan for turning paper into searchable text with a phone camera, and developer-facing APIs that let large enterprises automate document processing directly inside their own system at scale. The pricing on top of all of that is engineered with real precision. Acrobat Standard, the cheaper entry tier, only runs on Windows, a restriction that quietly forces every Mac using professional straight into the pricier Acrobat Pro, whether they wanted the exact features or not. Business teams pay a small premium over individuals for identical software, simply for the privilege of centralized management tools an IT department needs. And committing to a full year costs noticeably less per month than paying month to month, which functions less like a discount and more like a quiet penalty for staying flexible, nudging almost everyone into a locked 12 months contract that protects Adobe's recurring revenue. Acrobat alone now accounts for well over 60% of everything this business, professional, and consumer segment of the business earns. and roughly a sixth of Adobe's total revenue, built entirely on a format Adobe technically gave away for free. The remaining slice of this segment comes from Creative Cloud, reaching outside the enterprise entirely. Deep discounts get the whole suite into schools and universities for under $20 a month, deliberately training an entire generation of students to depend on Adobe before they even draw a corporate paycheck. Individual hobbyists rent a single app like Photoshop or Lightroom without buying the full bundle. And Adobe Express, a stripped-down, template-driven tool aimed at small business owners and office staff who will never learn Illustrator, exists for one specific reason: to make sure that when someone just needs a quick flyer or social posts, they reach for an Adobe product instead of wandering off to a certain Australian competitor that has built its entire empire on exactly that kind of customer. We will come back to that competitor soon enough, because it turns out to be the single biggest threat on this list. Two very different customer bases: professional studios who cannot leave and casual users renting a PDF reader somehow combine into one of the most efficient cash machines in modern software. Roughly 95% of everything Adobe earns is recurring subscription revenue, rather than one-time sales. And by the middle of 2026, that recurring base had grown past $27 billion, still compounding at double-digit pace that few companies this large can sustain. That predictability alone is worth something on Wall Street, since investors will consistently pay more for a dollar of revenue they can count on next year than a dollar that might vanish the moment the customer walks away. Follow that revenue down the rest of the income statement and the story only improves. Net income has climbed more than 300% since 2017, diluted earnings per share has increased more than 400% over the same stretch, and net profit margin has settled into a stable band in the high 20% range. Holding remarkably steady through a pandemic, an economic slowdown, and an entire artificial intelligence panic that was supposed to be terrifying for Adobe investors. Subscription businesses are built to survive exactly this kind of turbulence because the revenue doesn't evaporate the moment a news cycle turns negative. Underneath all of it sits a cost structure almost no physical business could ever replicate. Gross margin runs above 89%. 89%, let that sink in. Meaning that once Adobe has built Photoshop's algorithm or trained a Firefly model, signing up one more paying subscriber costs next to nothing beyond a sliver of cloud server bandwidth. A company making physical products drags raw materials and shipping costs along with every single unit sold. Adobe doesn't. Free cash flow margin runs close to 41%, translating into more than 10 billions of pure spendable cash every year before stock-based compensation. And return on invested capital has climbed from around 20% to briefly above 35%, while return on capital employed has gone from about 24% past 50%. So where does almost $10 billion a year in spare cash actually go? Well, almost entirely into buying back Adobe's own stock. Nearly $9 billion worth in the most recent year alone, at a pace that has only accelerated. Total share count has fallen by close to a fifth over the past decade, and fewer shares outstanding means that same climbing net income gets divided among a smaller pie. Now to the part every investor and every creative professional actually worries about. Artificial intelligence can generate an entire image from a sentence should be one of the biggest threats imaginable to a company that sells image editing software for a living. Adobe's answer was not to fight generative AI, it was to build its own and wrap it in exactly the kind of legal protection a nervous enterprise customer actually wants. This AI is called Firefly, and it doesn't search the internet, copy existing artwork, or stitch together pieces of someone else's photo. Built on a diffusion model architecture, trained on billions of images, it starts from pure statistical noise, a random pattern that looks like static and calculates an entirely new arrangement of pixels from scratch, guided by whatever a person types into a prompt box. It has effectively learned the real-world rules, how light, shadow, and perspective behave, which is why it can generate images, vector graphics, text effects, and even video and audio, not just flat pictures. Change one number in that starting noise, and an identical prompt produces an entirely different result, which is why the same request can generate practically infinite variations. Ask it to add an object into an existing photo, and it doesn't simply paste something on top. It reads the lighting, the shadows, and the angle of everything already in frame, then renders something that behaves as if it was already physically there. A real leap past the old cut and paste tools Adobe used to ship, which mostly cloned nearby pixels and often left behind faint, repetitive smear. And let me get into the thing that actually matters commercially. Firefly was trained exclusively on Adobe's own stock photo library, openly licensed material, and work old enough that its copyright has expired. No customer's private files were used to train it. And critically, Adobe backs every image Firefly generates with a legal indemnity. If a business gets sued over something Firefly produced, Adobe absorbs the legal and financial risk itself, not the customer. For a general counsel at a Fortune 500 company deciding whether marketing can even touch generative AI, that single guarantee can be worth more than the technology itself. Firefly lives directly inside the tools professionals already pay for. As generative fill inside Photoshop, generative extend inside Premiere Pro, and text to vector inside Illustrator, alongside a standalone web version and a bulk production tool called Firefly Boards for producing hundreds of campaign variations at once. Enterprises can even train custom versions of the model on their own logos and brand guidelines, so the AI stops generating generic stock imagery and starts generating things that actually look like one specific company ads. And every image it creates gets automatically tagged with what amounts to a digital nutrition label, recording that it was AI generated, which is Adobe's answer to a world increasingly worried about deepfakes and manipulated media. Adobe has folded generative AI into the subscription itself, selling generative credits as an add-on layer on top of the price customers already pay. Whether this turns out to be a durable moat is still an open question. The threat AI poses to Adobe hasn't gone away. The company likely faces real pressure at the low end of the consumer market, where cheaper or free AI tools compete directly. And it may lose some pricing power at the high end too. Firefly has a strong hedge, but it's a bet, not a guarantee after all. Which leads us to the fact that every one of Adobe's flagship products has a specific challenger aiming directly at it, and each fight reveals something different about how durable this business really is. DaVinci resolves challenges Premiere Pro and After Effects, with faster rendering across multiple graphic cards, color grading tools that are genuinely the industry standard, and a one-time license running around $300 instead of a subscription that never ends. What it still lacks though is Adobe's tightly wired connection between apps, and its node-based visual effects workflow feel foreign enough that motion designers who grew up on After Effects tend to avoid switching at all. The Affinity suite challenges Photoshop, Illustrator, and InDesign with a generally modern lag-free code base and a one-time purchase price instead of a subscription. Now backed by serious resources after Canva bought the company outright. What it still lacks is the enterprise IT management large companies actually require, and its files can quietly break formatting the moment they get exported into Adobe's own native formats. The same formats an entire industry still runs on. Figma's story is the most dramatic of all, because Adobe already tried to make this particular problem disappear entirely. Back in 2022, Adobe agreed to buy Figma outright for roughly $20 billion. Regulators in Europe and the United Kingdom blocked the deal over competition concerns, and by the end of 2023, Adobe was forced to walk away, handing Figma a $1 billion breakup fee for the privilege of failing to acquire it. Adobe's own interface design tool, Adobe XD, had already been effectively pushed out of the market by Figma's browser-based, real-time collaborative editing, and losing the acquisition meant Adobe now had to compete with a fully independent, publicly traded rival instead of simply owning it. Figma went public in 2025, and its revenue has kept climbing since, crossing $1 billion for the first time by the end of that year and continuing to compound at close to 45% a year. Figma's advantage is real-time, multiplayer editing built for the browser from day one. Its weakness is that it barely functions offline. It has no real answer for print design, CMYK color, or the advanced vector work agencies still need for physical packaging and branding. Salesforce Data Cloud challenges the experience platform ecosystem by leaning on its near monopoly over corporate sales and customer relationship data, letting marketing teams unify customer profiles without hiring a dedicated data engineering team. Its weakness, though, is years of acquired, patched-together legacy systems that struggle to deliver true real-time data across web and mobile, along with a rigid setup process that ends up just as complex as whatever it was supposed to replace. The largest threat by far is Canva, and it is not really a single product threat at all. Canva has built template-first, drag-and-drop design tool now serving over 250 monthly users, deliberately avoiding the intimidating blank canvas that scares away anyone with formal design training. Deliberately avoiding the intimidating blank canvas that scares away anyone without formal design training. It has already bought the Affinity suite to reach semi-professional designers and Cavalry to push into motion design, and through further acquisitions and its own AI tools, it keeps expanding into copywriting, publishing, and analytics, quietly assembling an entire marketing operating system inside one browser tab. None of this threatens Adobe's enterprise colorists or ad agencies directly. What it threatens, though, is the bottom of Adobe's funnel. The exact hobbyists, students, and small business owners Adobe is counting on to eventually grow into paying professional customers. When an entire generation of casual creators grows up never touching Photoshop or Illustrator at all, Adobe is not losing today's revenue, it is losing tomorrow's. So, return to that split sitting inside Adobe's own internal reporting. Two segments, professionals who cannot leave and casual users Adobe's patiently trying to convert. One side defended by file formats and industrial pipelines built up over decades. The other side defended by a habit-forming free product funnel and a document format Adobe deliberately gave away 20 years ago. Lay artificial intelligence on top of both sides, not as a replacement for Adobe software, but as another feature bundled into the same subscription, and you start to see why this company keeps generating $10 billion of pure cash every single year, even while critics keep predicting its extinction. Adobe is not really in the business of helping people create pictures, videos, or documents. It is in the business of making sure that once you start creating inside its ecosystem, leaving becomes more expensive than staying ever was. That, ultimately, is how Adobe actually makes money. And if that sounds like a hostage situation, well, at an 89% gross margin, Adobe is not exactly losing sleep over what you call it.